welcome back to the show. I'm Ozbourne Foreman and this is the Ozbourne Foreman Show. Yes, it is a day later than usual and that is going to be a new thing on this channel. Sundays at 9 AM. This week I'm discussing the stock market and its valuations, how that impacts my portfolio and whether we should really be looking out for a stock market correction. Is it incoming? Is the bubble about to pop? I've also created a Twitter account, which is probably now the best way to contact me. So if you're interested, please look in the link in the description below and give me a follow. Don't worry, I'm not going to spam you with YouTube links. I'm merely just going to update you on what's going on with the channel and my business life. And make sure to stay tuned to the end of the videos. I'm going to be talking about a new stock I've added to my portfolio. One of my smaller positions listed in the FTSE 100 has seen quite some controversy this week. TSCO, Tesco, or my personal favourite, the tractor supply company, has seen sales rise across the board due to the whole pandemic situation. They've seen their established stores see a rise in 8.7%, as well as their online sales rising by 48.5%. However, they have seen about a 20% decline in their clothing sales, but it is promising for the company. But during this time, the current CEO, Dave Lewis, has had a 30% increase in his salary, which is higher than any one of his previous CEOs except Sir Terry Leary, which was over a decade ago. And obviously these shareholders did not like this one bit, and that was shown by a roughly 70 to 30% split, 70% going against his payment. And this is supposedly due to the fact that they'd stopped comparing themselves to Ocado. Ocado is an online-only food delivery service and only has around a 1.8% market share overall. I think this is quite typical of Tesco. They seem to be very hubristic around smaller retailers. They believe that they're on top, so why not look at these discounter stores like Aldi or Lidl, right? And this is their downfall, like seriously. The fact that they ignore these is why they've been losing market share. However, in recent years they have been combating this. And whilst this is a step in the wrong direction by ignoring Ocado, they are combating Aldi and Lidl. And in fact, over the last few months since the pandemic, they've actually clawed back some of their market share. Whether this will be short-lived or not, I am not sure. However, they're planning to price match with that of Aldi. And you know what? I'm sure they could do it. And that's why, even though it's one of the smaller positions in my portfolio and they can be a bit hubristic at times, they do have a good dividend income and hopefully will continue to grow it. I don't see much capital appreciation on this stock, but I do seeing it as a good, strong defensive hold that will be reliable in the future. In fact, two fairly large businesses in the UK have been into administration. Obviously, you would have known of Debenhams, which is a clothing store and brand which has many stores nationwide. And they went into administration for the second time in 12 months back in April. But there's also been another, and this is Into. Into is a real estate income trust that owns a bunch and variety of shopping malls. And what's happened is due to the fact that we've had lockdown, we can't really go out and the shopping malls haven't really been doing anything, meaning a lot of the rent payments by their tenants would have been missed. It's led to a decrease in the demand for it. And in fact, it hasn't been a promising industry due to the rise in online retail and sales, meaning that the shopping mall has been less attractive to go to, and this has been a downwards trend over the last few years. I'm not so optimistic on this, but I have seen malls done well, and I know that they are a staple part of that town's community, so I do believe they aren't going anywhere too soon, and currently at their ridiculously low share price, it could be worth a speculative investment. I'm not going to touch it, but it is interesting to see. They don't plan on just liquidating their assets and giving up, however. They're purely into administration just to raise income and restart pretty much. But they have been decreasing over the last 5 years of something like an average minus 70% earnings. So they've been decreasing, and I think their profit margins at the moment are like minus 220%, which is ridiculous. However, this really could play off. Like, there's a lot of potential upside if malls do see a rebound. However, it's definitely going to be a long-term spec play, and I'm not touching it. In the US, there has been a new spike in pandemic cases. And in fact, it's higher. These new cases are higher than that ever before. It's currently totaled around 40,000 in one day, June 25th, which had beaten that of its peak in April. Which is alarming because I suspect the second wave is closer than we anticipate. And whilst we are not in the US, this could still follow suit. And if you're interested in my pandemic second wave stocks, then click the card at the top right of the video. With that in mind, the FTSE 100 is down 2% and the FTSE 250 is down 3% for the last week, which really isn't much volatility compared to what we've seen in the past. And I believe it's because we know a lot about this disease now, or this pandemic. We have a greater fear of what we don't know. And because we understand this more and more, people are becoming less fearful. And this will subsequently lead to a second wave. But what is interesting is how the stock market is going to react to that. And I'm not too sure. I don't think if it will crash that it will go anywhere near as its bottom in February. However, I do suspect there is room for a correction. And over the last few days, we have seen that sort of drop. This week, I've seen dividend income from both BP and Shell. However, BP was on the Friday the last week, was around £4. Shell had given me £7.98, which isn't much, but it's something, right? I was initially planning to reinvest my energy dividends into a Greencoat UK Wind Trust, but for the time being, I think it can be better invested elsewhere, which I immediately invested these dividends with an additional £525 of deposits in the last week, and I reinvested that into some stocks, which I now own 400 shares of Redrow at an average buy price of 455 pence per share each. And I probably won't be adding to this position unless it drops below 400 pence per share. I'm happy with this. It's a good amount of equity and I'm very bullish on Brexit and the house building economy. And I think with Greencoat UK Wind, I'm better off developing my existing positions before opening more. National Grid managed to perform the best this week, getting around a return of 2.5%. And this is really why I like the utilities sector. It's typically quite resilient to that of the market and sees more of a demand when there's a sell-off for normal equities or more riskier assets. So these guys do well. However, I suspect this is due to them confirming their dividend and growing it by around 2% last week. If you haven't seen last week's portfolio update, then please click the card at the top right of the video, in which I go into this at more detail. Games Workshop has also rallied around 1.5%. And this is just one of those recession stocks really. Whilst it is consumer discretionary, as likely very cyclical, it's a hobby stock. And I think that the demand for these items and assets will likely not decrease that much. And typically they are one of the stronger companies during a recession. So to be fair, I think that this stock will continue to perform and I'm going to keep buying it. However, there has been much more rises than fallers, such as Diageo, which has fallen by 6.66% in the last week. I know this is starting to get cryptic. It's like I'm about to be possessed by some kind of demon. Anyway, I believe this is due to the uncertainty of the pound, and currently we have seen its value drop. This is mainly compounding the fact that the pandemic is ongoing with that of Brexit. So it is understandable. Even in the last week, I don't remember who, but they had suggested that the pound is more like an emerging market currency, which is due to its high volatility, which puts it into perspective. And Diageo, I think, denominates most of their currency in dollars, and so the shift in the pound height and low, meaning that they will struggle the most because they do a lot of imports and exports in the UK with their brand of spirits and alcoholic beverages. However, in recent news, they've also announced that they're going to be funding bars and pubs an additional $100 million to that around the globe. And in England, in the UK in particular, I think they're designating around 20 million, and that's for hygiene products so that they can support the bars and pubs in their reopening on July 4th. So I am a little bit confused as to why the stock market has dropped. However, this is good positive news and something I like about the company. They are really doing well. Remember, temperatures have been high lately. Keep hydrated. Currently, my portfolio is up around 4.5%, which is still underperforming that of the FTSE 100 and 250 at around 8% and 10% respectively. And this has been since the start of April, more specifically April 7th, which is when I first bought a position in this portfolio. However, this metric is slightly skewed as it's just simple returns. It's not money weighted as much. Take it with a grain of salt. I'm going to compare it broadly to say that's how well I've performed. but I reckon once I get more intelligent with spreadsheets, I'm going to develop on this further. But what I am curious about is that the markets in the UK, the FTSE 100, the FTSE 250 are only down 20% year to date, which is concerning. We were pricing in Brexit beforehand, but like, it's still ongoing. Brexit's going to happen at the end of this year. The fact that we're only down 20% and we're possibly in the deepest recession of, I know for sure, my lifetime, and most of the viewers watching lifetimes as well, and yet we're only down 20%. That is something to worry about, and this could lead to the idea that the stock market is overvalued. And a lot of people have thought that. In fact, a majority of people suspect there's an incoming crash within the year. But I feel that if there's so many people suspecting a crash, maybe it won't happen. And in fact, what if prices just continue to rally? So what if we talk about the chances of a correction instead? A correction is a drop of around 10%. And a correction is more likely. And I see this as possibly the last buying opportunity that we may see in the near-term future. And I've actually not seen many institutions, although I don't track them very well and I'm not really that confident in that sector at the moment, I haven't really seen institutions buy much assets right now. But eventually they are going to have to start buying again, otherwise they're just going to underperform the market. And when that happens, stocks are likely going to go up again, right? So this could be one of the last times of this period. However, I could be completely wrong and we could see a crash where we lose 90% value. So I'm only speculating here. Don't take this as financial advice. But when they do this is likely going to increase prices and valuations. And in fact, typically at the moment, the UK market is sitting on around a price to earnings ratio of around 15 times. The S&P 500 in the US is sitting at around 23 times. I think that price to earnings ratios aren't going to be as low as they are now in the next 20 to 30 years. And in fact, I think that due to the amount of quantitative easing in the market, the prices are going to remain higher. And you're going to be paying more for a less amount of earnings. And I think this trend was shown before in the Great Depression of around 1930. And I think price to earnings ratios were lower then and haven't actually reached that level ever again. And so if we do see a correction, I'm likely going to try and make the most out of it. We could be entering a lost decade. A lost decade is the idea that we'll be trading sideways in a bear market, or even the new term, kangaroo market. But even then, it could just go down and it could rise up, but it won't reach the amount of a recent high. And this could happen for the next 10 years. And that is scary to think about, but then you really need to think about your strategy. I'm invested in dividend growth stocks, meaning that I'm still going to be getting a dividend income throughout this time period, allowing my portfolio to continue to grow and also compound. Growth stocks aren't left out though, because if there are, there will be certain stocks that you can make money on despite the market falling. And this has always been the case. When you're looking at growth of earnings, it's likely going to outperform that of its market anyway. So these strategies should still work. I should stress a warning for those with index funds though, because if the market does trade sideways, we may see some issues. These people with index funds may see their money just stagnate for the next 10 years. The FTSE 100 does offer a high dividend yield, higher than that of its American counterparts. And the FTSE 250 is in a similar position. And these dividends will help you compound your overall returns, but I don't think it will be enough. It might not work out. And in fact, I think index funds are even riskier, as valuations are so high at the moment compared to when comparing market cap to gross domestic product. The Buffett indicator compares market cap to GDP. And currently, the market has not been this overvalued since the dot-com bubble in 2000, suggesting right now that stocks are extremely overvalued, which presents significant risk for those invested, as those invested at the peak of the dot-com bubble didn't see some of their company share prices ever recover anywhere near that level. And in fact, the FTSE 100 has been trading sideways for the last 20 years. I know dividends make the difference and you will see a significant difference with dividends reinvested. But if you'd have bought at the peak of the dot-com bubble, I think you'd still be down. That's how ridiculous it is, and that's why I'm so worried about index funds. And this is likely the reason why Warren Buffett isn't actually buying any stocks at the moment. I don't know Warren Buffett. It's not like I just met him down the cafe and I have a chat with him every week. I don't know what's going on inside his head or Charlie Munger's, but I am interested to know. But I think the most important thing is to stay invested, keep buying assets, and don't sell. Unless obviously the company is going to zero, in which case get the hell out of that stock. And over this time period, you would have built up a large, strong portfolio with such a range of companies, and the equity in them will be quite high. And then after this period, when the market finally hits a bull run and gets out of the sideways trading, you could likely see great returns. Just remember, investing is a marathon, not a sprint. Don't put all of your energy into the start and then realize, oh no, I've missed out. Consistently keep your pace, which is cost averaging, and don't stop. Although I only really have around 15% cash sitting outside of the portfolio, which has dropped significantly over the last, or since starting this portfolio, I plan on probably clearing this. I'm going to put most of this into the portfolio. I've still got my emergency fund, don't worry about that. But that's going to go into the portfolio, and then I'm just going to continue to cost average whilst building up the cash position. And I know each week I've said, hold cash, don't hold cash. And it's very similar to that of what Boris Johnson has been doing with the announcements of the pandemic. Go home, go outdoors. You get the idea. That's my Boris voice. It's terrible. I don't really keep up with that, so it's probably nothing like it. And this is the early days for me. I am selling a few positions here and there. That's because I'm still learning these companies listed in the UK. I'm still understanding this, right? That's only fair. And I think after the first year, my portfolio is going to remain very consistent. And therefore it will just be a case of, right, put money into this stock, this stock, this stock, and consistently develop these positions rather than looking for new positions, because I am discovering these new companies and I do like them. I will likely hold, currently I've got 14 positions. I will likely hold more than that in the future, less than 20 though. I am looking for some speculative stocks, so we'll see how that goes. And I have actually been buying into a new stock. And this stock, whilst I'm not going to talk about the fundamentals right now, I will on Wednesday. So make sure to click the subscribe button and the notification bell, as that video will be coming out soon. I recently discovered WH Smith, or the ticker symbol SMWH, which is a bit confusing considering I had seen their high street stores and thought, well, they're not really doing much. They aren't making much for profit. However, where the impressive part lies is when you look at their business strategy, and it lies in how they're expanding their stores to the travel hubs. So you've got things like train stations, motorway service stations, airports, and that is where they make their money. They have diluted their share pool to acquire 2 American companies that they can expand out in there. I am very bullish on the potential outcome of the company. I think the stock price is something like 60% down since its recent highs. I've only really got around 19 shares, giving me an equity of around £200 at the moment, but I do plan to add to this position and push it further up. This will be one of my stronger positions, and I say that about a lot of companies, but I follow a general strategy which Warren Buffett created. And that's the idea of having your top 5 to 6 positions take up 50 to 75% of your portfolio. Currently that is the case, but that's what I want, and then the other companies provide smaller diversification bonuses but aren't as large. However, this could be a falling knife. It's very likely that I could get hurt and cut, hence the falling knife. You catch it, you get cut. And it's very likely that this could continue to drop and I'm going to lose a lot of money. However, I'm going to keep averaging into it so that doesn't matter. Coming up, ex-dividend stocks to buy right now, and that's coming out on Monday at 2 PM, so make sure to subscribe. Thank you. This is the Ozbourne Foreman Show. Thank you for watching. Have a good afternoon.